Hello and welcome to the channel. In this video, we're going to learn about the cash flow statement. It's part of the big three financial statements out there along with the balance sheet and the income statement. By the way, if those statements are interesting to you, in the description below we have links to the similar type lessons around the balance sheet and income statement. You can check those out as well. But cash flow is nice, and why a lot of investors, for example, like the cash flow statement is it's something that's very hard to adjust or manipulate, anything like that. Balance sheet, income statement, you can kind of do things to make the numbers look a little better legally. You can do that. Some things to adjust the numbers a little bit. Where cash flow is a little bit more raw. I mean, cash is either coming in, you're raising your cash balance, or it's going out. You're reducing your cash balances. And we're going to look at the different ways that's accounted for and look at the statement, how money comes in and how money goes out. And as investors, how we can kind of look at that and interpret, is that a good thing or maybe not so much of a good thing? So we're going to use Tesla as a real company. We're going to use a real company. We're going to walk through Tesla's cash flow statement line by line. So you can kind of learn about that. Now, with companies, you can find their cash flow statements on their web pages, usually on their home pages, either right at the very top or at the very bottom. You'll be under a part that says investors or investor relations, those kind of things. Tesla's unusual where they have a menu on the side, at least their current website version, and so you have to kind of click down to find it. But either way, you can find their more detailed and the complete statements there. We're going to use Yahoo Finance, which gives you a ton of great information and really everything you need to kind of go line by line in. And so we're going to use that because it's a nice free resource that we can use, and then you can use it for other companies you might be considering too. And we'll walk through line by line on the cash flow statement. All right, so with that, let's get started learning all about the cash flow statement. Okay, I'm over here at Yahoo Finance or finance.yahoo.com. Let's look up Tesla and we're going to look at their cash flow statement. Again, you can put in the name or the ticker TSLA, and we're going to go to the cash flow statement, and you can see the quote here. You want to look along this ribbon here for all sorts of good information, and we're going to go to financials, is where our financial statements hang out and hide. Basically. And you have income statement, balance sheet, and cash flow. It'll fall to the income statement. So we want cash flow. So we're going to click on cash flow and have that reset there for a second. Let's try that again. There we go. And so here we are at cash flow. You can see that's where it says cash flow. And we can look at our cash flow either on an annual basis, where it typically defaults. You can see these are the different years, or we can look at the last 12 months, the trailing 12 months on that cash flow statement. But let's say we want to look at it quarterly. So I'm just going to click on quarterly, and thus we can see the last 12 months, the trailing 12 months, or we can look at how each quarter has been doing for more recent information. And that's a really good way to look at it because we want to see how is our cash position being adjusted up or down based on, not only over the years, but also more recently as well. One quick thing too, that all the numbers are in thousands. So if we look at this 9,931,000, that's not 9,900,000 or so. That is actually adding on a comma and 3 more zeros. So it's in thousands. So that is 9.9 billion. 9,931,000,000. This would be 3,147,000,000 and so on. So just remember it's in thousands. So cash flow, again, is all about is money coming in or is money going out in terms of our cash and our cash position. Different than the income statement, which is we're really trying to answer the question of are we making money or losing money? The balance sheet, which is kind of our report card, like what's our current snapshot in time? And then our cash flow is like looking how much cash do we have, in effect cash and cash equivalents in the bank. And what's happening with our cash? Is our cash flowing out? Or is our cash flowing in? Think of your own bank account. Is your money flowing into your cash, into your bank account from maybe your salary or things like that, and your bank account savings is going up, thus your cash position is going up? Or are you paying out more in terms of like your credit cards or other bills, rent, mortgage, whatever it might be? And how are you doing with that cash flow, going up or positive? In the end, we want our cash flow to be positive, but there's some things we need to spend cash on, and we need to buy things. So we'll see negative parts in our cash flow statement too. But in the end, we want to see an ending cash position that is a positive number. As you can see here, both the trailing 12 months, and you can see over time, over these last 4 quarters, we have this positive cash position. But how do we get there? And that's where the other big parts coming here is the operating, investing, and financing. This is the key, is these 4 top parts, particularly these 3. And then we'll talk a little bit about this extra stuff, which is kind of a little bit more extra bonus information. But you really want to understand these three in particular, because that's going to help you get to your ending cash. So as we know, operating cash is like from our operations. So we're looking at Tesla here. Are we selling cars? When we sell a car, we get money coming in, right? When we make a car, we got money going out, maybe to buy materials and things. Investing is investing in our business. Are we buying plants and equipment, or are we selling that stuff off to try to raise cash? Again, this is all about, it's different than the income statement. It's all about what is happening with our cash going in or out. And financing is like related to investing. Tesla does not pay a dividend, but let's say it was a company that paid a dividend, that means money's going out of our cash because we're using it to pay our shareholders. Or if we're selling stock, to raise money, that would help our cash position because we're basically having money come in. So it's all about the flow of cash. So let's look at these three buckets in detail so you can understand it more. So first off, operating cash flow is basically our operations. And you'd want to look at it and say, okay, we have $9.9 billion over the last 12 months for Tesla from their operations in terms of cash coming in. And what does that look over the quarters? Are they all positive? Are some quarters negative as far as more cash flowing out? And you can see over the different quarters, these are all positive numbers. They're all kind of right around the same, although we had some nice cash things both at the beginning and at the end of these last kind of quarterly periods. So ending up with our operating cash flows. But let's dig deeper into that. How is money kind of happening through there? So this is from operations or continuing operations. We're selling cars, right? So if we look at it, we have cash coming in from net income. That's our profit, right? That's things. So thinking about the income statement, right? We've got profit coming in. And when we make profits, we've got, cash coming in. After we paid all our operating expenses and things, we've got cash coming in. So that's our net income from continuing operations is at $3.5 billion. And that can be adjusted by operating gains and losses, right? Maybe we sold some property, plant, equipment, or there's a foreign exchange thing where we have from our operations part of the foreign currency exchange, might be a small number. We'll actually see more foreign currency exchange stuff more inside the financing part of it. But you can sometimes see little numbers in here too. But this is our basic operational gains and losses. Are we operating from an operating standpoint? This is net income coming in, but is there some gains and losses from the operation standpoint? The other thing where we're taking money, basically in or out is from depreciation and amortization. So you think about depreciation from a cash standpoint, we're depreciating an asset. Maybe we've got equipment, trucks, whatever it might be, and we're depreciating that, saying it's not as valuable. So when we depreciate that from a cash flow standpoint, that's basically, in effect, adding cash to us because we're not having, in effect, think about the cash again flowing, and we're depreciating that asset. We're not buying an asset, we're actually taking a write-off on that, which makes our cash position go up. Later we'll learn about free cash flow, which can be a better number as far as kind of taking that kind of a big number out of ends up being a big number, which it is for Tesla. So they're doing a lot of depreciation. But again, this is all about cash coming in, cash coming out. So stock-based compensation or asset impairments, is that good or bad? Small number here in relation to the big 9.9 billion for the total number. A smaller number here for asset impairment of our different assets that we might own. Are they being impaired? But here we see a bigger number for stock-based compensation, and you can see how that's being adjusted each quarter. So that means we're taking cash out of the company and we're paying compensation with stock. Think of it like stock options for executives. So when Elon Musk pays himself and there's executive team, for example, stock options, or paying stock compensation. So instead of paying a salary, we're going to give you more in a bonus that could be salary, but maybe our bonus is going to be in stock options. Then that's stock-based compensation. That's money going out because we're basically compensating people instead of salary. We're compensating with stocks, and that's adjusting our cash flow. And you can see they pay a lot in stock-based compensation, which you can see a lot in especially growth companies where they pay more around compensation for growing the company to their employees who are getting stock options. And then there's other non-cash items. These are things where you'd want to go to the company's website, look at their detailed income statement to see what might be making up that type of thing. And then change in working capital. Remember if you think of income statement, working capital is looking at our current assets minus our current liabilities, right? So, our change in working capital, we're doing better as far as current assets going up versus current liabilities. Current assets being things like cash and accounts receivable, those kind of things. And this is where it can get tricky. So let's look a little closer at this one. Change in working capital. So we have change in receivables, right? So a receivable is accounts receivable. You can see it's the same number here. So they could just label this change in accounts receivable. So accounts receivable is where we're receiving money in from people who owe us money. They bought a Tesla on a credit card, or they bought a Tesla and they owe us money, right? So this is the change in the cash position. So if this is a negative number like it is here, that means our account receivables are going up. That means more people owe us money. So in our cash position, we don't have cash coming in from accounts receivable because it's gone up. We have actually cash, in effect, flowing out, is the idea. Versus, let's say, money flowing in like this, looking at this quarter here, we had cash coming in where people are paying their debt to us. They're paying us $135 million, and thus our change. And you can see how these numbers are change. It's the change accounts receivable. If you were to look at the balance sheet, you'd actually see the raw number of how much money do we have in accounts receivable. This is looking at the change in that. So this is where financial statements can be tied together, where the balance sheet and the cash flow statement are tied together through accounts receivable. Another way, maybe an easier way to look at this, is through change in inventory. So inventory, do we have more completed cars that we own? So this is a value, right? Or do we have less completed cars because maybe we're selling them, right? So we don't have that inventory, or inventory of raw materials or work in progress. Either way, what's happening with our inventory in terms of a financial basis in our operations? And you can see our change in inventory. We have negative 995,000 in cash. What that not thousand, million in cash. This is our cash flow out. So that means we're putting more money into building up our inventory than what we're selling in inventory, right? So this is not necessarily bad. That means we're making cars, and if we look at our income statement, things, maybe we're selling more cars, and in order to sell more cars, we need to make more cars. If we look back at the different quarters, you can see these were all negative numbers, but here we had 180,000, or I keep saying that, 180 million, excuse me. So that means our inventory went down in effect, and thus that's changing our cash position. So these are different ways of looking at cash from prepaid assets. Then you have payables, right? So we have payables and changing in our payables. This is money that we owe out, right? So this would reduce our cash position in terms of if we're paying our payables, if we're paying our accounts payable, which would be another company's accounts receivable. If we're paying, then this would be a negative number. This would be adjusting our overall cash position down. We're looking at cash from continuing operations, this bucket. So that's a big number. What does that mean? That means we're not paying as fast on our accounts payable. That, from a company standpoint, that's not a bad thing, because then we can use that money to invest in the company, earn interest in our, a little bit of interest in our bank account. Companies don't want to pay their accounts payable fast. They want to get their accounts receivable in fast, but they want to slow down their accounts payable. And that's why you see positive numbers here, because it's money that we owe. We have to account for that. It's going to reduce our cash position at some point, but right now we're not paying it. So, we're kind of retaining that cash. And then you have changes in other current accounts payable. So you'd want to look at that. And this might be a company example where you want to look in more detail on it, at the company's more detailed full income statement and some of their comments that have that. Change in current liabilities. This again was change in current assets, not accounts payable. Change in other current assets. Change in current liabilities. So these are kind of offsets, and then change in other working capital. These are these things that are happening through the income statement, the balance sheet, things that are changing these asset, liability, and working capital combinations. But all these numbers add up, and both positive and negative, to give us this 9.9 billion. Let me go back up here. 9.9 billion in cash flow. That means 9.9 billion over the last 12 months is coming in. And we've adjusted for money that's gone out, or adjusting for that, like money we've sent out for payables, and money that technically in effect has come in because we're holding off paying on accounts payable. A little tricky there, but that's the idea that you want to really think about this operating cash flow, and we want these to be positive numbers. Are we building our cash numbers by operations? Because a lot of times investing and financing is what's going to reduce this number and reduce our cash position typically. Now investing, think about not us investing as stockholders or working with the stock markets. That's going to come under financing. We're going to look at investing from the company's perspective. Are they investing back in the company? Are we buying things? Are we investing in the company? And as you can see, Tesla does a lot of investing back in its company to the tune of almost $7 billion. So they're making cash come in by their operations. That's a good sign. By operating, by selling cars, they make $9.9 billion. But we need to invest to keep that number going good. We need to keep that net income and our profits going good. So we need to invest in the company. So that's where our investing cash flow is. And over the trailing 12 months, the last 12 months, that's about $7 billion, 69999, right? So let's look more closer at that by hitting that down arrow and looking at those continuing operations cash flow from investing standpoint. So what are we spending money on to get this big $7 billion? And what we're really spending money on as Tesla is PPE, right? Property, that stands for property, plant, and equipment. So we're buying equipment, we're buying properties, we're building factories, we're investing in the company, to build out more. We want to, maybe build out more factories internationally, for example. So we're going to invest in that. And that takes money, that takes cash, right? So we are investing in that. So let's look at that a little closer. And you can see it's been pretty consistent as far as continuing investing back in property, plant, and equipment. And it doesn't give you the detail as far as what specifically. It might on the website, or you might hear management guidance saying we're building a new factory wherever. Where here it's really just a repeat of the same thing. So we know this is going into property, plant, equipment. We might have to go to the website or to their specific stuff and really dig into the company deeper to see, well, what property, plant, and equipment are they buying? Now, net intangible is just kind of this, intangible stuff or some unusual stuff that's going on versus more traditional stuff of property, plant, and equipment. And if we look at this number over the last trailing 12 months, we can see we had nothing the last 2 quarters, zero. And then we had a big expenditure here, 1.2 billion, and then just a very small expenditure in the quarter before that. So most of it all happened here. And if we click onto that, we can see we purchased something. I'm not sure what intangible thing Tesla purchased, but they bought something for 1.5 trillion to invest, or billion to 1.5 billion to invest in the company. That wasn't part of property, plant, and equipment. It's some type of intangible thing. So maybe it's intellectual property. Maybe it's something that they're investing in the company that they bought in, right? And then they have a sale of some intangible, something intangible that they're selling, and to offset that a little bit, or maybe they just did an accounting adjustment. So in this case, usually you won't see anything there, but if you see something, it might be a big number pop up. If you're real curious about it, that's where you want to dig in and say, okay, what back in March there did they spend 1.2 billion on? And then you have just kind of this catch-all of net other investing things that are in there. Again, investing is all about investing in the company, and that's going to be investing primarily in property, plant, and equipment. And if it's something different, you could want to look into that, like this intangible thing for Tesla. All right, so that's brought our number down, right? Money's flowing out, almost 7 billion flowing out. But the good news is 9.9 billion flowed in. But we saw here under financing cash flow, we had more money flowing out, 1.25 billion flowing out. Money could flow in from financing, by the way, but we have it flowing out. So why is that? And an interesting thing here, if we go back, and we'll explore this further as we dig into this, but we had money flying in, almost 2.7 billion coming in back here in December of this quarter, and then we have money flowing out. But boy, look at all that money coming in, and look, all that operating cash, flow was good, real good, and then we didn't have much in property, plant, equipment. So this was quite an interesting quarter here. So what's going on in financing? That we have this big number here of money coming in, but over the last 12 months, we have money going out. That's why it's a negative number, and money being cash. I'm going to click on this. This is just a repeat, so we have to dig a little bit deeper in here. All right, so let's dig in here. Let's dig in on this. So what happened here? So we have net issue payments of debt. So what does that mean? That's our debt, that we're paying our debt. That's a good thing if we pay our debt. We got to pay our debt, and that's the debt number, right? So if we dig deeper, we'd see long-term debt issuance. That means we're taking on more debt, which improves our cash because we're issuing debt. We're issuing a bond. We're selling something that if I give you a bond, to you, in return I'll pay you interest rates for things, but I'm issuing debt and I get money from that debt. repayment of long-term debt, that's payments, that's the company paying in on their debt. Like if they borrow money from a bank, for example, that they're paying their debts, right? So this is where they're issuing debt, which causes cash to go up because they're getting paid for debt they're giving out. And this is payment of debt of the company paying their debts. And that's typical where you can see this is a much bigger number. Banks might be a little bit different, where banks are really issuing a lot of debt because they're in the issuing of debt business, things like mortgages, stuff like that. So if we look at our net long-term debt, and by the way, this number is going to come up again later on, 9.5 issuance, 6.1 a payment. You'll see that down here when we get to this part, which we'll get there quickly here. You can see where those numbers repeat is just a highlight. They highlight those because you can see it's kind of hard to dig. You have to dig far to find it. All right, so we know the net, and then the net is the difference, between all these numbers, right? The 9.5 versus payment out of 16 billion, that gives us our net of 6.5 out, right? Of payment. Net long-term payment, issuance, or payment is basically what that should say. So, well, that's great. And it's great that we're paying our debts and things. But wait, what's this here? What's this big number here? And as you can see, where we talked about, where our financing cash flow were popped up here back into that December 2.6 positive versus everything else being negative. And we're wondering, well, where did that come from? Well, we can dig deeper and we can see right now it came from net common stock issuance. Nothing here, nothing here, nothing here. 4.9, almost 5 billion of issuance of stock. That's issuing, and that brings cash into the company. And that popped up that financing there, where the other ones didn't because we were paying our debts. So that's that 4.987 billion in net common stock issuance. So what's going on here? Well, basically Tesla, when they sell stock, when a company offers stock for the very first time, they go from private to a public company, as you may know, that's an initial public offering, right? They're offering their stock, they're selling their stock to the public. And the reason they sell their stock to the public is when you buy that initial stock offering, that raises money for the company that they can then use to invest in the company in things like property, plant, and equipment, for example. Or to pay off shareholders, all sorts of different things they could do with, issuing that, pay off executives and things like that. So, or private investors. So what Tesla did was, boy, our stock was really rising at this period. Look at how much that stock is worth. Let's issue some more stock and look at and if we do, we'll raise almost 5 billion of stock that we can invest in the company. That's great for the company, by the way. They just got basically $5 billion. But by doing that, they dilute the shares of stock. So if you're an existing shareholder, your stock is worth less in effect because they issued all these new shares, right? So that dilutes the shares of stock. So sometimes you'll see stocks drop when they do that. Not too long ago, Virgin Galactic, the space company, issued a bunch of new shares and their stock dropped 13% in a day because they needed it really more to keep the business afloat than, let's say, Tesla, who's like, I'm just taking advantage of a situation here. And that's what that net common issue in stock is. That's what they did, issue common stock here, right? So if we look at that financing operations, the overall thing ended up being a negative 1.2 billion because we had 6.5 going out in terms of cash going out from along our debt, and then we raised stock, as far as money coming in, and then we had proceeds from stock options and other financing charges to kind of make all these numbers add up and true up, right? So other different more detailed things. So if we look at the three big lines, we did great as far as 9.9 billion over the last 12 months in operating, investing, which is investing back in the company, which is a good thing, but it costs money to do that. That's 7 billion. It can be a good thing, and if it's investing because we got to pay our debts, that's a different thing, and that's where financing comes in as far as the payment of our debts. So this is investing company. This is basically related to debts and issuance of stock. And we answered our question like, why did this number pop up? And if you look at it, this is probably not going to be a regular occurrence as far as financing cash flow. Well, next year will they issue more stock? They may not, and so that might cause that cash to go down. And that's what this is doing, is we then start getting to some of these other things here, which is, and we really also have no important number to hang in there on, is this free cash flow part, which is our ending cash position. So this, sometimes you might think, well, does these three numbers add up to this? And as you can see, it doesn't, right? It does not add up to the ending cash position. Also, this is a case where the ending cash position is a static number. These four numbers don't equal that number. It's really, this is now where these other categories, these numbers add up to these trailing 12 months. This is a static position answering the question, how much cash do we have on hand? What is our ending cash position? And that should tie out or relate to our balance sheet. When you look in the balance sheet and you look at assets and you look at cash, that's where these numbers will link up. So that's our ending cash position. And you want that number to be obviously positive. They'll usually be positive, but you don't want that number to be going down precipitously. You can see it has been going down a little bit over these last quarters, but a lot of that is because we're investing back in the company, right? So, which has helped growing our operating cash flows and help grow our net profits and things. So that's not a bad thing. It's just what you want to be aware of what's going on there. So if we click on this and we look at our ending cash position, how do we get there? Well, first off, we have to look at our changes in our cash position from the previous period. So since we're looking at the last 12 months, so this is where we'd want to go to an annual number. Remember, we go up here to look at annual. We'd want to look at our annual and look at our cash flow as far as the change from the last 12 months to the previous 12 months before that. That difference will be the changing of the cash position. If you look at each quarter, you can see how the change in cash position is happening here. Between these different numbers here, as far as changing in the cash position. That's why these are smaller numbers. See how how this was, we'd have to look at the previous period here, but this was a big jump because we had this big jump in financing and operating cash flow. So, and then we have, and I know this will make a little more sense in just a second. Just hang in there 1 second here on this part. But you can see, if we look at I'm going to drop down here to beginning cash position was 16.8, and because that number ties to the previous quarter, 16.8. So a better way to start would be, we ended our cash position in June here at 16.8 billion. So our beginning cash position, when we're going to adjust for it in September, is 16.8. These are the same exact numbers. And then we adjusted for our change in cash position, basically what's going on up here. And then if there's an exchange rate thing that's impacting that, many international companies that sell a lot of stuff or things that do things internationally, their cash position changes just looking at cash because the exchange rate and the cash changes. The US dollar is not the same in September as it was in June and not the same in March. So they're adjusting for these changes in exchange rates that might be happening. So that 16.8, you adjust for the change in cash and the exchange rate, and that's your new ending cash position, which where the quarter after this will now begin the new beginning ending cash position, just like here 16.8 to there. If we look at 17.7 ending to 17.7, adjusted for the change in cash, bigger number here, and change in exchange rates, now we're at 16.8. So I hope you saw how this static number is a real interesting number of something to look at as far as our changes in our cash position. But these are the three big buckets that you really want to dive into, because these three things is what's influencing that number, that ending cash position change. The rest of the stuff is, you may see on Yahoo Finance, you may not. Depends on the company where they automatically or if they're pulling certain things. Here they're looking at capital expenditure, which is investing in, pulls out some of these hidden numbers, deep buried numbers, pulling off maybe the website and the real specific stuff. Capital expenditure is CapEx, or it might be known as CapEx. That's where they're investing in physical assets. So physical things being capital in terms of, capital assets, property, plant, equipment, things that are physical, but even deeper than what PPE might show under, let's say, investing cash flow. Issuance of capital stock, well, we saw that in our financing thing. This is just calling that out because that's an unusual type thing. You can see that for the last quarters that they didn't issue the capital individual stock. This is not physical stuff. This is actually common stock that I can buy. So that got called out. And then this also gets called out because it ties into free cash flow, which is important, which is issuance of debt. Are we issuing debt that's bringing cash in, or are we paying our own debts, which is taking cash out because we're paying our debts? When you pay your credit card, you in effect are paying your debts, right? You're paying your credit card bill. That's repayment of debt, is what's happening there. So free cash flow is looking at things like your operating cash flow less your capital expenditures is what's happening here. And so when you're looking at your debt things, this is where that's called out so you can kind of see what debt's on. But when free cash flow, which is separate, we're looking at how much free cash does management have to spend on stuff. That basically we're taking out a lot of this financing, a lot of the investing, a lot of the other debt stuff, things that we're obligated on, and say, how much do we have that management should say, hey, go have a good time, go pay you've got 2.5 billion over the last 12 months you can spend on stuff. Here you can see how they arrived at that number, right? We've got free cash flow, positive numbers. Negative free cash flow is not a good thing. It means, hey, you get less money to spend on good stuff. So how does free cash flow, where's that number come from first off? Well, it's basically looking at your operations. This is management, right? We're looking at how are your operations doing? So we're looking at that 9.9 billion over the last 12 months. And then what we're taking out of that is our capital expenditures. That's why it was important to really, without digging, pull out that number that Yahoo provides us for. And the difference, 9.9 billion to call it 7.3, 7.4 billion with some rounding there, that's our 2.5, right? All right, I hope that helped you out as far as understanding the cash flow statement. I certainly really encourage you to take a look at the other videos around the balance sheet and the income statement. These big three financial statements really give a good rounded picture of a company that you might be looking at, particularly if you're an investor. So I'd encourage you to do that and look at these companies and look at those videos and look at companies that interest you, of course, and start comparing as you continue your learning, looking at these big three financial statements. And also, if you really like this type of content around investing and all that, hey, do consider hitting that subscribe button. That would be great. Love to see you as a subscriber. With that, enjoy reading these financial statements, and especially the cash flow statement, and I wish you all the very best of luck.